Welcome to the Deep Dive. We're your shortcut to understanding what really matters across, well, a pretty huge stack of sources.
Yeah, huge stack today. We're covering a lot of ground.
We really are. We're going from the absolute cutting edge of AI research, high-frequency trading, all the way back to, 19th century steel mills and their PR fights, plus the rivalries that basically built Silicon Valley.
It sounds like a massive jump, I know, but there are these surprisingly consistent questions underneath it all.
Like what?
Well, like, what specific strategies really work, technologically, financially, even psychologically, to get that kind of market dominance?
And maybe more importantly, where do these incredibly ambitious leaders draw the line? Or maybe don't draw the line, ethically or in terms of human cost?
Exactly. Our sources really dig into that disruption, those really intense personalities you seem to need for transformation.
Yeah, the hidden costs, right? The things that don't always make the headlines.
Yeah, the hidden costs. So we're not just telling stories here. We're actively looking for the patterns, the sort of constants of how power works across different fields.
Okay, so what are the big themes jumping out from all this material?
Well, three things really stand out. First, this constant battle between, companies sticking with what works, organizational inertia versus the absolute need for rapid innovation.
Okay.
Second, the kind of personality it takes. Often it seems pretty extreme, almost pathological sometimes, the drive required for that kind of leadership.
Right, the great man theory, but maybe with a darker side.
Maybe. And third, the way financial risk and global wealth are just concentrating more and more, driven by some, well, pretty fundamental economic forces.
Okay, that's a lot to unpack. Where should we start?
Let's begin right at the frontier, the thing that's reshaping everything right now, the new economics of AI.
All right, AI. I think when most people hear AI, their minds immediately jump to, science fiction, Skynet, HAL 9000, artificial general intelligence, AGI.
Right, the thinking machine, the one that can do any intellectual task a human can. But the sources are pretty clear. The experts think that kind of true AGI is still quite a ways off.
Further away than we might think.
Yeah, farther away than often imagined is how one source puts it. And it's not just about throwing money at it. It's about fundamental breakthroughs in understanding cognition, intelligence itself. We're still kind of missing the basic architecture for real reasoning beyond just, really sophisticated pattern matching.
Okay, so if AGI, the sort of holy grail, is still out there on the horizon, what's happening right now? What's driving all this investment and changing how companies operate today?
So today is really the age of implementation. It's less about pure science breakthroughs and more about, well, industrial work.
Industrial work, how so?
It means gathering massive amounts of the right data, tweaking the formulas we already have, running experiments with algorithms, building prototypes for specific tasks, and just trying out different business models really, really fast.
So the advantage isn't necessarily in the lab inventing something totally new.
Not right now, no. It's more on the factory floor, so to speak. The factory floor of data. That's where the competition is really happening.
But even if it's just narrow AI, just implementation, the sources suggest the economic impact, the potential crisis from this is huge.
Oh, it's monumental. The projections are, frankly, alarming. We might be looking at a situation within, say, 10 to 20 years where 40 to 50% of existing jobs in the U.S. could technically be done by AI.
40 to 50%. Wow. That includes things like admin roles, maybe some coding, data analysis.
Even some creative tasks, potentially. Yeah. And this isn't some slow, gradual change. The sources frame it as a rapid structural shift in the labor market.
And what does that mean for the average person, even someone who doesn't actually lose their job? If AI can suddenly do half of what you do.
Well, it hits your bargaining power hard. Even if you're not replaced, if a significant chunk of your tasks can be automated, your unique value add to the company goes down.
So the company can argue they don't need to pay you as much.
Basically, yes. They can credibly say, well, we could find someone else or an AI to do part of this cheaper. So you see downward pressure on wages.
Okay.
And then you've got a bigger pool of people who are unemployed or underemployed, all competing for fewer jobs, especially those needing higher skills or just pure service roles, which pushes more people into part-time work or the gig economy.
Right, the precarious work without benefits, healthcare, retirement.
Exactly. It's a potentially devastating cycle for a lot of workers.
And this tech advantage isn't just changing jobs. It's shaping geopolitics, too, creating a kind of bipolar world.
Yeah, that's a key point. When you look at who's leading in AI, it's not about who has the biggest army.
It's about
Infrastructure and data. The US and China have already built up what the sources call an enormous lead over everyone else.
Why them specifically?
It's a combination. They have these huge venture capital ecosystems ready to pour money into deployment. But, crucially, they also have massive populations, hundreds of millions of users generating unimaginable amounts of data constantly.
And that data feeds the AI, making it better.
Which generates more users or more engagement, which generates more data. It's a virtuous cycle. And as their AI gets better and better, that lead just gets wider and wider, making it really tough for any other country to truly compete at the same scale. Hashtag tag 1.2, early tech giants, and the battle for standards.
That idea of getting an early advantage, locking things down, that takes us right back to the beginnings of the tech world we know today.
Yeah.
Let's talk about those early battles, especially the big one. Gates versus Jobs.
Oh, yeah. They really represent two fundamentally different ways of thinking about business, don't they? You had Steve Jobs.
The perfectionist.
The artist. Right. He wanted total control. Hardware, software, content, everything tightly integrated, beautiful, seamless. But ultimately, a closed system, his vision governed everything.
And then you had Bill Gates.
The pragmatist, the ultimate capitalist analyst, maybe. His focus was completely different. Market domination through ubiquity. Get Microsoft software onto every possible machine.
So the opposite of Jobs is closed garden.
Totally. He was willing to license the OS, the software, to basically anyone building a PC. He sacrificed that aesthetic control, that tight integration, for just sheer scale and market share. Openness was the strategy.
And this pragmatism, this drive, sometimes put him in conflict even with his partners, right? Like that early dust-up with mites over basic.
Yeah, the sources mention that. Roberts at MITes refused licensing because of market conflicts, and apparently Gates and Allen were told they couldn't even talk to other potential customers without MITes' permission. You can imagine how frustrating that must have been.
And that frustration boiled over later with IBM too, didn't it? Over the 286 chip.
Oh, famously. Gates apparently went off about IBM's, and I quote, fed-up strategy.
Wow. What was the issue?
IBM, specifically an executive named Lowe, insisted that the new operating system had to run on the older 286 chip. Why? Because IBM had sunk a ton of money into the older PC app models and felt they couldn't just abandon those customers.
Protecting the legacy business.
Exactly. And Gates saw this as pure corporate inertia. He thought sticking with the old tech, protecting that investment, was a massive strategic mistake that would hamstring their ability to compete in the future.
That's fascinating. So even way back then, you see this core tension, the push for new standards, new tech, versus the huge weight of existing corporate structures and investments wanting to slow things down.
Precisely. It's a recurring theme. Hashtag tagged 1.3 retail and corporate disruption.
And these same forces, scale, pragmatism, disrupting the established players, they weren't just happening in Silicon Valley. You see it clearly in the physical retail world too. Sam Walton and Walmart. That's a classic story.
Oh, absolutely. It's like a textbook case of disruption by, as Walton himself put it, just flying under the radar.
It really maps onto that innovator's dilemma idea, doesn't it? When Walmart started in the early 60s, all the attention was on the big guys.
Yeah, Kmart, Target, Woolco. They were the giants. Kmart hit, 250 stores and $800 million in sales in just 5 years.
Oh.
Tiny in comparison. 19 stores, maybe $9 million in sales. The big chains were focused on fighting each other in the major cities. They basically ignored the rural markets Walton was going after, thinking they were too low margin, not worth the effort.
And they just let them grow.
Pretty much. Walton said they were able to fly under everybody's radar until we were too far along to catch. It's that classic blind spot. Established companies often dismiss low-margin competition until it's suddenly scaled up and eating their lunch.
It's like the arrogance of high margins.
Yeah.
You don't want to touch a business that doesn't meet your quarterly profit targets.
And you leave the door wide open for someone nimble to come in and build scale where you refuse to look.
Yeah.
You saw something similar later with, say, Uber versus the taxi industry, right? Exploiting the inefficiencies and high costs created by the incumbents.
Definitely. And Walton knew exactly what his advantage was, didn't he? He even apparently gave advice to small stores on how to compete against Walmart.
He did. He understood scale and efficiency were his weapons. But he told smaller merchants they needed to lean into the one thing Walmart couldn't easily replicate: the personal touch.
So don't get into a price war over commodities.
Exactly. Trying to beat Walmart on toothpaste prices? Pointless. He said small shops needed to rethink their whole approach to merchandising, promotion, Get out on the floor, know every customer, build real relationships.
That personal connection was the differentiator.
Right. That was the high-value service that Walmart's super efficient, scaled-up model couldn't fully match. And that goes back to the innovator's dilemma point. Big successful companies often miss these threats because, initially, they just don't look financially attractive enough according to their existing metrics until it's too late.
Okay, so strategy is key for disruption. But the sources also really emphasize the personalities involved. It seems you need a certain kind of extreme drive, maybe even ruthlessness, to make these huge changes happen.
Yeah, ambition, real empire-building ambition, it seems rarely comes wrapped in politeness or excessive consideration for others. Ray Kroc is a prime example.
The McDonald's guy.
Yeah.
He had that grinded-out work ethic, but there was more to it.
Oh, yeah. A really intense, ruthless, competitive streak, especially when it came to controlling the brand.
The story about him and the original McDonald brothers is pretty brutal. They sold him the concept but wanted to keep their first restaurant.
They did, in San Bernardino. They renamed it the Big M. And Kroc apparently saw this not just as, like, an administrative headache, but as a goddamn rotten trick.
Why? Because it wasn't part of the official chain.
Partly brand consistency, maybe needing that specific location. But Kroc saw it as a competitive threat, undermining the integrity of the brand he was trying to build nationwide. His response, though, it went beyond just business logic.
What did he do?
He waited a bit, then deliberately opened a brand new McDonald's right across the street from the Big M. And he operated it so aggressively, priced so low, he basically just ran them out of business.
Well,
He might have felt bad later, reportedly, but in that moment, it shows this deep, almost primal urge to eliminate any competing variable, anything outside his control.
that's a different kind of ruthlessness than, say, Andrew Carnegie dealing with the Homestead strike aftermath in 1892. His approach seems more calculated.
Definitely more calculated. Carnegie was a master of not just controlling capital, but controlling the narrative. After the violence at Homestead, he realized he was losing the war of public opinion.
So he went on the offensive PR-wise.
Exactly. He shifted from just trying to crush the union physically to trying to win hearts and minds. He told his partners to start emphasizing acts of kindness. Things like investing savings for the workers at high interest rates, funding the library.
So not addressing the core issues like wages or working conditions directly, but creating this image of benevolence.
Precisely. It wasn't about genuine altruism. The sources frame it as weaponized goodwill. His explicit goal, his instruction, was to prove that non-unionism is better for the men than unionism. By providing these other benefits, these comforts and pleasures, he aimed to make the union seem less necessary. Compensate for lower wages or harsher conditions with paternalistic care, undermining the union's appeal as a source of support and solidarity. It's cynical, maybe, but incredibly strategic corporate social responsibility, way before that term was common. Hashtag tag 2.2, the price of perfectionism.
But that relentless drive, whether it's Krukey's brand control or Carnegie's narrative control, it often comes at a steep price, doesn't it? Especially for the people working closely with these leaders. Steve Jobs and the Macintosh team seem like a case study here.
Oh, absolutely. Jobs' pursuit of perfection for the Mac was legendary, but so was his behavior. The sources describe it as stormy and abusive.
And it affected the project.
Massively. The Mac project fell way behind schedule, went hugely over budget, largely because of Jobs' impetuous interventions, constantly changing things, demanding the impossible.
People must have been burning out.
Totally. Significant burnout on the team. It led Steve Wozniak, his co-founder, to reflect later that maybe a mix of their styles, Wozniak's more easygoing approach, and Jobs' intensity might have been better than just Jobs' way all the time.
So the perfect product comes at a human cost.
Often, yeah. The visionary leader creates something amazing, but can leave a trail of exhausted, stressed-out people in their wake.
And if that need for control goes completely unchecked, it can become something else entirely. Pathological even. Like Howard Hughes in his later years.
Hughes is the ultimate cautionary tale, isn't he? Control turning into crippling paranoia. His late-life behavior was just bizarre, intense isolation, obsessed with germs, and this deep fear of being watched or listened to.
Didn't he have that weird thing about telephones?
Yeah, he somehow got it into his head that the only safe, untappable phones in all of New York City were inside the Waldorf Astoria Hotel.
Seriously. So how did he even communicate?
Imagine being his lawyer, Raymond Cook. The poor guy was apparently exhausted just running back and forth to the Waldorf whenever Hughes wanted to talk.
What were the instructions?
Hughes told his staff, his operations, that Cook had to be put in a room where he was completely private. But that wasn't enough. There also had to be empty rooms on either side of Cook's room, with the doors to those empty rooms kept closed.
It's elaborate.
It's theatrical, pathological, spending fortunes, causing massive inconvenience just to maintain this illusion of absolute privacy and security. It really shows how extreme, unchecked ambition and control can curdle into something totally counterproductive. Hashtag tag 2.3, the modern leader's image and reality.
Moving into more modern times, leaders still grapple with that ambition, but also with the image they project. Sometimes they're trying to shape their own story, or maybe they're struggling under a legacy of control, like with the Gucci family.
Right. The Gucci story is fascinating regarding inherited control. Maurizio Gucci apparently really suffered under his father, Rodolfo's super strict formal upbringing. Even as an adult, Maurizio couldn't just ask his father for money. He was apparently afraid to. He had to go through the family driver, Luigi Pirovano, or the secretary, Roberta Casal, just to get pocket money.
Wow. That's infantilizing.
Completely. And it meant he never really developed the confidence or maybe even the practical skills to handle the family empire when he inherited it. There's a damning quote from an administrator. Rodolfo gave him the castle, but he didn't give him the money to maintain it.
The control was so tight it actually undermined the heir.
Exactly. Sabotaged him, in a way.
We see a different kind of image control with someone like Henry Ford, actively crafting his own origin story.
Oh, Ford was a master mythmaker. He pushed this narrative of himself as the lone genius overcoming obstacles, especially his supposedly backward-thinking father.
He portrayed his father, William Ford, as dour and hidebound, someone who hated his mechanical tinkering.
Yeah, but the sources say that portrayal was largely self-serving and distorted the reality. His father was actually quite progressive for a farmer back then, interested in the new machine age, and apparently encouraged Henry's mechanical skills.
So Ford needed that narrative of struggle against the old ways to validate his own success.
It seems like it. Creating a myth of singular vision against opposition is a common trope for transformative leaders.
And then you have the modern competitive ego, maybe less about myth-making and more about just winning decisively. Laurie Ellison in the America's Cup seems to fit that mold.
Ellison's drive there wasn't just about sailing. It felt like it was about proving technological dominance. He made this huge, risky bet on the hard-wing sail design.
Which was complex and maybe unproven.
Very complex, very unforgiving. But his justification was pure competitive logic, brutally simple. The other side isn't trying to build one, so we'll have a wing and they won't.
He wasn't looking for a small edge.
No. He wanted a fundamental game-changing advantage that the competition was too afraid or too conventional to pursue. It shows how that raw competitive ego can actually be the engine driving radical innovation, forcing a leap nobody else is willing to take.
Okay, let's shift gears a bit to the purely financial world, because the concentration of money, how it moves, the risks involved, these are arguably the biggest forces shaping things globally now. Where better to start than Thomas Piketty's big idea?
Right. Piketty's observation about tortoise, it sounds technical, but it's incredibly powerful.
Remind us what that means again.
Basically, $3 is the average rate of return on capital investments, stocks, real estate, whatever, and $5 is the growth rate of the overall economy, wages, output. Piketty's point is that historically, Torrelli tends to be consistently higher than dollars.
So wealth grows faster than the economy.
Exactly. That's what he calls the fundamental force for divergence. If you already have capital, your wealth tends to grow faster than the income of people who rely mainly on their labor.
Why is that simple inequality so powerful over time?
Compounding. Most people earn wages and spend most of them, but returns on capital dividends, rent, capital gains can be and often are reinvested. So wealth doesn't just grow, it compounds. And it compounds at a rate faster than the underlying economy is expanding. Over decades, this inevitably means inherited wealth and existing fortunes pull further and further away from what someone can earn just by working.
And the data shows this isn't just theory, right? We're seeing wealth concentration levels heading back towards historical highs.
Absolutely. The sources point out that back in the late 19th century, private wealth in places like Britain and France was worth maybe 6 or 7 times the entire national income.
Oh.
That ratio dropped dramatically between, say, 1914 and 1945 because of the world wars, destruction of capital, inflation, high taxes.
But since then,
it's been steadily climbing back up. Since around 1950, private fortunes have grown relentlessly. We're now approaching those same levels again, 5-6 years of national income held in private hands. The overall magnitude of global wealth inequality today is startlingly similar to what Europe looked like back in 1900 or 1910.
Can you put some numbers on that? How concentrated is it now?
It's pretty staggering. If you look globally, the top 1,000, that's 0.1% of the population, owns almost 20% of all global wealth.
1/10 of 1% owns a fifth of everything.
Yeah. And if you broaden that to the top 10%, they own somewhere between 80 and 90% of global wealth.
Which leaves not much for everyone else.
Very little. The entire bottom half of the world's population owns less than 5% of total global wealth. That's the stark reality that Carnegie's over time creates. Hashtag tag 3.2 corporate financial strategy.
And that massive pool of capital has obviously changed how financial institutions operate, especially private equity. There was a shift, right, away from just using debt.
Yeah, a big shift in the buyout model, particularly after the excesses of the 1980s.
The LBO era, leveraged buyouts.
Right. Back then, a private equity firm might buy a company putting up only, say, 5 or 10% of their own money, the equity, and borrowing the other 95%. Pure leverage play.
What changed?
Well, the markets tightened up in the early 90s. Lenders got nervous and started demanding a lot more skin in the game from the private equity firms. Instead of 5–10% equity, suddenly they needed 20–30%, sometimes more.
So they couldn't just rely on debt anymore to make money.
Exactly. They couldn't just borrow huge amounts, hope the company did okay, and make a killing from the leverage. They had to actually improve the company they bought to justify the price and generate returns on that bigger chunk of equity they put in.
And that led to this idea of value creation.
That became the buzzword. Firms like Blackstone realized they had to, as one source puts it, burrow deeper into the nitty-gritty of their operations. They had to genuinely find ways to make the business run better, streamline management, fix logistics, upgrade technology, boost cash flow, less financial engineering, more operational improvement.
Was it all operational genius driving their success? The sources seem to suggest timing played a huge role, too.
Oh, a massive role. Blackstone, for example. While their co-founder, Tony James, often emphasizes operational improvements driving gains, a closer look shows they made a lot of their money through shrewd timing.
Buying low, selling high.
Basically, they were really good at investing heavily when markets tanked, when assets were cheap and everyone else was panicking. So a big chunk of the financial improvement you see in the companies they bought can actually be traced back simply to the market recovering, the business cycle turning up again, not just the operational changes they made.
So smart opportunism was just as important as operational skill.
You could definitely argue that. Their success seems to be as much about when they invested as how they managed the investment afterwards. Hashtag tag 3.3 moments of financial failure.
Of course, the flip side of all this high-stakes finance is when things go wrong. Spectacularly wrong. And nothing looms larger in recent memory than Lehman Brothers. The sources suggest that collapse was maybe avoidable.
Agonizingly close to being averted, it seems. The story goes, according to Blackstone's CEO Stephen Schwarzman, that there was a plan discussed with Lehman's CEO, Dick Fuld.
What was the plan?
To split Lehman in two. Create a good Lehman with the healthy investment banking parts, and an old Lehman to hold all the toxic real estate assets that were dragging it down. The thinking was this would remove the uncertainty hanging over the healthy parts of the bank, and the government might allow it.
Sounds logical. What went wrong?
Timing and, well, ego, maybe? Fuld apparently hesitated. He was agonizing over the price, the valuation he'd get for the bad assets, even as the clock was ticking towards the quarter end when he'd have to mark them down publicly anyway.
You couldn't let go.
Reportedly, he was haggling over a price that was already in the low single digits per share. There's that famous quote attributed to him, reacting to a lowball offer. No fine way.
So while he was haggling,
they ran out of time. Not enough time to do the due diligence, get the SEC approvals needed for the split. That indecision, prioritizing a few cents per share over saving the entire firm, led directly to the biggest bankruptcy in U.S. history and triggered a global meltdown.
Meanwhile, while firms are collapsing, some individuals in finance are managing to make absolutely incredible amounts of money, like Stephen Cohen in the hedge fund world.
Ah, Steve Cohen. He's sort of the ultimate example of how performance can dictate terms in that world. Hedge funds usually charge 2% and 22% management fee, 20% of the profits.
But Cohen charged more.
Way more. He kept 50% of the profits his fund, SAC Capital, generated, half.
How could he possibly get away with that?
Pure performance. His returns were so incredibly good for so long that investors didn't care about the sky-high fees. They literally fought to get in, according to the sources. They were desperate just to get access to the remaining 50% of those amazing returns.
Yeah.
It shows that in finance, if you deliver results that nobody else can match, you can pretty much write your own rules.
Okay, for our final section, let's look at how power works with information itself, controlling it, suppressing it, misusing it. This spans everything from corporate scandals to global influence.
And Theranos, Elizabeth Holmes. That's become the poster child for just outright corporate deception in recent years, hasn't it? Using lies to keep the money flowing and control the story.
The sheer audacity is still kind of shocking. How exactly did she maintain the illusion for so long, especially in public?
Well, publicly, she just delivered bald-faced lies, as one source puts it. She flat out denied using standard commercially available lab machines for those fingerstick blood tests, insisting they were using their revolutionary Edison devices.
Even when reports surfaced showing they were using commercial machines.
Yeah, she'd claim those reports referred to old technology that Theranos hadn't used in years, just doubling down on the lie.
And internally.
It was apparently even worse. Lab staff reported being pressured by her partner, Sunny Balwani, to basically ignore quality control failures on the Edison machines and just run patient samples anyway. The deception was total, from the public statements down to the actual lab practices.
That pattern of putting profits ahead of truth, ahead of people's well-being, it echoes unfortunately strongly with the OxyContin crisis and the Sackler family's role.
It really does. Purdue Pharma, owned by the Sacklers, found itself under fire for fueling the opioid epidemic. Their defense strategy involved trying to shift the blame.
Well,
They pointed fingers at the makers of generic opioids, arguing that most opioid prescriptions filled weren't for their brand name OxyContin, but for cheaper generics.
okay.
But this argument was called egregiously insincere in investigations. Why? Because the Sacklers secretly also owned one of the biggest manufacturers of generic opioids in the U.S.
Wait, really? So they were blaming a problem they were also directly profiting from?
Exactly. Shifting blame with one hand while raking in profits from the very thing they were blaming with the other.
And the human cost of that deception, when investigators actually looked.
It's chilling. An investigation by the Massachusetts Attorney General, for instance, cross-referenced death certificates with prescription records. They found 671 people in Massachusetts alone over about a decade who had filled prescriptions for Purdue's painkillers and later died from opioid-related overdoses.
That directly contradicts their claims.
Completely. It statistically blew apart the company's long-held lie that addiction caused by legitimate doctor-prescribed use iatrogenic addiction was incredibly rare, practically unheard of. The numbers told a very different tragic story. Hashtag tag 4.2, the weaponization of information.
Moving online, information platforms themselves are now arenas where influence is fought over. Instagram's approach to sponsored posts seems like a really interesting example of managing information, or maybe not managing it.
Yeah, it's described as a kind of regulatory dance. Very sophisticated, actually.
How did it work?
So, Instagram's official rules did state that influencers had to disclose when a post was sponsored. Posting ads without saying so was technically a violation.
Okay, seems straightforward.
Instagram didn't really enforce the policy. They didn't actively police it or penalize people for breaking the rule.
Why not?
Well, by setting the rule but not enforcing it, they effectively shifted all the legal responsibility, the liability, onto the individual influencers and the advertisers themselves. Instagram got the benefit tons of engaging, commercially valuable content without the headache or cost of actually ensuring compliance with, say, FTC guidelines.
So the result was?
Predictably, chaos. One study found something like 93% of sponsored posts from top influencers didn't have proper disclosure. The platform facilitates the behavior while dodging the responsibility.
We see a similar tactic, using information and funding strategically. In politics, too, right? Especially with those front groups.
Oh, yeah, classic move. Using deliberately misleading names to push a specific agenda. The example given is these TV ads in Montana attacking a proposed cap-and-trade bill aimed at reducing CO2 emissions.
Who ran the ads?
The sponsoring group had this curiously benign name, CO2 is green.
CO2 is green. Seriously.
Seriously. But when you trace the funding, it quietly came from Corbin Robertson, a businessman who happens to own the largest private reserves of coal in the United States.
Ah. So hiding the financial interest behind a neutral-sounding, almost pro-environment name to lobby against climate action.
Precisely. Using financial power to obscure the source and bias of political messaging. injecting doubt while pretending to be objective.
And then there's the truly dark side of global information and power, where state protection enables outright criminality on a massive scale. The arms dealer Victor Bout comes up here.
Bout is an incredible example of how global black markets operate with high-level protection. The key concept here is the Russian term krisha.
Krisha, what does that mean?
Literally, it means a roof. But in this context, it refers to political protection, often from powerful officials, intelligence figures, or even organized crime. It's this deep, often corrupt, symbiotic relationship providing cover and advantages.
And Bout had this kind of protection.
The sources strongly suggest he did. He cultivated connections deep within the military and intelligence services, indicating he had very powerful backing and protection back in Moscow. He had krisha.
And what did that roof allow him to do?
Run a massive global arms trafficking network, essentially. Defy international sanctions, break UN arms embargoes seemingly at will. His companies reportedly made $50 million just supplying weapons and military gear to the Taliban when they controlled Afghanistan.
All enabled by that political cover.
Exactly. His operation, as one source describes it, paints an amazing picture of how corrupt many parts of the world are, where huge criminal enterprises can thrive because they are intertwined with and protected by elements within the state itself. Hashtag tagged 4.3 political leadership under scrutiny.
Sticking with Russia, even leaders known for absolute control, like Vladimir Putin, can find their image tested, especially during a crisis that exposes limits or failures.
Right, Putin built this carefully crafted image of decisiveness, of always being in control, but the Kursk submarine disaster really challenged that.
Also,
His response was seen as slow, inadequate. He seemed unable to control the military's chaotic rescue efforts, or perhaps unwilling to accept international help initially. And his perceived lack of empathy towards the families of the trapped sailors. It really damaged his image.
so the crisis revealed the limits of that control.
It did. It led to significant public criticism fueled by media coverage that really highlighted the human tragedy and the state's apparent failures. It showed even the most powerful leaders aren't immune when their core narrative of competence breaks down.
But Putin also showed he could wield power in other ways, particularly financially, to send unmistakable messages. That incident with the steel oligarch.
Igor Zuzin. Yes, that was a masterclass in using public shaming and state power to exert financial punishment.
What happened?
Putin, while prime minister, publicly called out Zuzin, the billionaire owner of Michel, Russia's biggest steel company. He accused Zuzin's company of dodging taxes by selling coal domestically at much higher prices than they charge for exports.
Just called him out publicly.
In a televised meeting, yeah. And the market reaction was immediate and brutal. Michel's shares, which traded on the New York Stock Exchange, absolutely cratered. They lost nearly $6 billion in value, over a third of the company's worth in a single day.
Wow. Just based on Putin's comments?
Just based on those comments. It was an incredibly clear signal to Zuzin and every other oligarch. Doesn't matter how rich you are, how global your company is, the state, specifically Putin, holds the ultimate economic power and isn't afraid to use it. Hashtag tag outro.
Okay, we've covered a massive amount of ground here. AI, 19th century industrialists, fast food empires, Wall Street collapses, tech giants, global arms dealers. It's a dizzying array. Is there one single connecting thread, one big lesson that ties all these stories of power, ambition, and disruption together?
I think there is. What consistently comes through across all these sources is that achieving success on this kind of massive scale almost always involves a willingness, maybe even a necessity, to destroy what came before.
Destroy your competitors or even your own previous success.
Both. You see it with Sam Walton ignoring the established rules of retail to build Walmart. You see it with Steve Jobs refusing any compromise on his vision, even if it burned out his team. You see it with Larry Ellison making that single huge tech bet that nobody else dared to make. These figures, they operate with an extreme focus, often pushing right up against or crossing conventional economic, ethical, or social boundaries.
They leverage whatever tools are available, complex finance, new technology, maybe even outright lies or exploiting loopholes.
All to get that edge, that advantage, even if it's only temporary. And that relentless drive for advantage, for efficiency, for profit, which really is the engine behind almost all these stories, brings us right back where we started, AI.
Right, that prediction of 40 to 50% of jobs being automatable soon, if that happens, if traditional labor loses that much economic value.
While capital, thanks to R. Giador, keeps accelerating its returns. then you have a fundamental crisis looming. If machines become, as you said earlier, the efficient cogs and gears driving the economy, what's left for people to do? What becomes the value of human activity itself?
That really is the big question, isn't it?
It's the central provocative question that all these forces seem to be pushing us towards. We might be heading to a point where economic value, in the traditional sense, productivity, efficiency becomes almost irrelevant for a huge portion of the population.
So what's the alternative?
Well, the hope, maybe the necessary adaptation expressed in the sources, is a fundamental shift in what society values. Maybe we'll be forced to recognize and reward things currently undervalued by the market. Caregiving, community service, education, artistic creation, personal growth.
Shifting from purely economic value to social value.
Exactly. Coming to value all of these pursuits, care, service, and personal cultivation, as part of our collective social project of building a more human society. If we can make that shift, if we can redefine value beyond the purely economic epoch, well, that would be the ultimate disruption, and maybe the most important one we'll face.